Welcome to Pro Trader Strategies Market Commentary for Tuesday, March the 8th. My name is Eric Wilkinson. Some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal, where I've commented on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, we're here to teach you some different strategies that you can implement into your own portfolios, but please do that in your own way. The reason why I can't give you a recommendation on a particular stock or strategy is because I don't know your risk parameters. I don't know what's in your portfolios. Therefore, what I'm doing could be counterintuitive to what you are already doing. Having that out of the way, not a whole lot of economic data coming out today. We did have German industrial production come in better than expected, a bit of a surprise there. Here in the United States, we got NFIB Small Business Survey or Small Business Index, and that is the National Federation of Independent Businesses. So the smaller businesses, the companies that have less than 250 employees, and they're asked about the economic conditions, prices they're paying, capital spending, inflation, and credit markets, things of that nature. So, and their inventories and sales, of course. Now, having said that, the overall NFIB Small Business Index came in at 92.9, was expected 94.5, but the real thing to see here is that has been on a slow decline since the beginning of 2015. So for over a year now, that number has gotten slightly worse. So small businesses are seeing some struggles there. Moving on to the markets, as you can see here, this is crude oil /CL. Yesterday we came up and tested that $38 a barrel area that I've been talking about. I said as soon as it got over 35, it was going to pop to 38, and that's exactly what it did. 2 days in a row, two big bars. Today we went up into that 38 area again and failed, and have just come off almost a little over $1, almost $1.50-ish just today. So the market's kind of given some back. I'm going to have a real itchy trigger finger on my USO trade that I have on. I'm long some USO. So I'm going to have a pretty itchy trigger finger on that because it tested there twice and doesn't look too good. But I'm going to try and hold off till tomorrow to make a real decision on that one. Moving on to the NASDAQ. As you can see here, the NASDAQ is pushing well off its lows, taken back over half of the losses that we were seeing earlier today, only down about 17 points. It is kind of leading the charge to the upside today, if you will. Yesterday it was lagging on the downside or on the upside. Today it is a little bit ahead of the E-mini S&Ps, as you can see here. Yesterday, E-mini S&Ps, the Dow and things, the other indices were slightly higher. Then the NASDAQ was showing a lot more weakness. Today, the E-minis are the ones that are showing the weakness across the board for the indices side of it. As you can see here, E-mini S&P is down about 15 points. On the daily chart, which is broken down into 15-minute bars, as you can see here below yesterday's last couple of days, actually value areas and right in the middle of the daily range for the most part. Moving on to some trades that I've done. So I'm starting to get geared up for earnings season, and you may ask why. Well, we can get ahead of this volatility expansion. As you can see on most volatility, or the highest volatility for these comes right in line with the earnings cycles. Last three at least, we've had a lot higher implied volatility environment this year, or heading out of last year and into this year. The volatilities just seem to creep up. But as you can see here, for the earnings cycles, they are much higher than normal. And right now we're, very near the lows of volatility seen in Pepsi, which is the PEP is the ticker symbols for that. And so since we're at this low area, what we're going to do is do calendar spreads and try and take advantage of some of that volatility expansion. Usually I talk about trying to take advantage of the volatility crush. Well, everything that has high implied volatility right now is something I pretty much have in my portfolio. So I also was looking at this to add some longer deltas on a down day that we have. I wanted to add a little bit of long deltas on this with relatively little risk. I'm still bearish short term, so this kind of works both ways. For the volatility expansion going into that, I think that these markets might rally on a couple of these because I picked some staples, but I'm looking for some volatility expansion coming into the next earnings cycle. So for Pepsi, I did the April 1 weeklies with the April 4 weeklies, and I did the 100 calls. So in the April 1s, I sold the 100 calls, and then in the April 4 weeklies, I bought 100 calls. So it's a call calendar, and I did it for I paid 71 cents for that trade. So what I'm looking to do is roll that April 1 weekly that I'm short out a couple of times going into that earnings, and try and collect a little bit more credit, lower that overall basis so I don't have as much risk at play, and then it going into that last earnings cycle, because the earnings falls in that April 4 weekly, I should see some expansion in that, and that will inflate those premiums even if I'm out of the money, and make that look a lot better. So that's what I'm looking for that trade. Ticker symbol PEP. Now on to another staple, Johnson & Johnson. JNJ is the ticker symbol. I did the same thing with the mindset of trying to finance some of those calls in the back months. So I did the April 1 weeklies with the April monthlies, and I did the 110 calls, and I paid 43 cents for it. So in the April 1 weeklies, I sold the 110 calls to help finance my April monthly 110 calls, and I paid 43 cents for that. So again, the idea is roll those April 1 weeklies out another at least expiration cycle and collect a little bit more premium, lower that overall basis, and hopefully have those long calls on for very cheap. So it is a play on volatility expansion and a little bit of a play on directionality. Like I said, if I'm short in the front month, I'm bearish short term, but for these stocks long term, because they're staples, they always seem to go up or at least trade relatively sideways. So I'm going to go into all the rules and how to pick those different strikes in the webinar on Friday. We're going to be gearing up all week for these earnings trades way down the road. It's not too soon to start looking at earnings trades, especially if you like being long options going into that, so you have a lot more potential profit, if you will. So this is a great way to set it up for that earnings cycle. So if you like to be long options, this is one that you have to watch and get in early. That's about all I got for you guys today. If you can't take that, take it easy.